Hello and welcome to Pro Trader Strategies Market Commentary for Tuesday, October the 25th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. A little bit of economic data coming out today in the form of the Richmond Fed Index. Came in at -4, was expected to be a -5. Those are the numbers that have been all over the board, and I would have expected to see those a little bit higher with the PMI numbers coming out, but those are more forward-looking. Richmond Fed is a little bit more of a lagging indicator. And we also got the CB consumer confidence number coming in slightly lower than expected at 98.6, was expected to be 101.5. We also got a flip side of that, which isn't as widely looked at, but the tip economic optimism came in at 51.3, was expected 47.6. So that was actually nice to see, to get above 50 for the bulls, if you will. And then we also have Mario Draghi speaking right about now, I would have to say. So I haven't heard anything what he's talking about, but he is speaking nonetheless. Crude oil back below $50 a barrel right now as we speak, 49.96. We got a rig count coming out at 533. So basically rig counts have been increasing throughout the summer pretty consistently for the most part, and we're at almost the highs we've seen since February. So a lot of rig counts out there. That means they're going to be pumping a lot of oil. At these levels, that makes them profitable. Same with the fracking. So we could start seeing the fracking here in the United States start to ramp up. One other caveat to that was Iran, I just noted, I think it was yesterday, was saying that they were not going to curb their oil, and they wanted to actually have a pass, if you will, from OPEC in their limitations on how much oil they're going to produce. Anyway, gold cruising higher, up $10 on the day, 1273.79, and the key thing to note is that it is just above that 200-day moving average. So finally broken above that resistance level. The bears seem to be winning at this point. The reason being is the overall equities are down and bonds are up as well, and that Fibonacci 50% retracement level is really holding strong as a support. Yes, of course, we have broken down below that, but it has been settling pretty much above that. So that line in the sand has been holding strong. We also, with the Fed governor saying that they weren't going to increase interest rates at this next meeting, has given life to the bulls in the overall financial futures, and we're cruising right back to that point of control that I've talked so much about. That's the magnet. Anyway, Dow Jones Industrial Average down over 60 points right now. The overall market has been testing that 200-day moving average. It looked like we could stay above that yesterday, but it failed on that move late in the day, and we are now back below that resistance level, and that is acting as a key resistance level for the equities. NASDAQ down 16 points on the day, coming back down to test this value area high. And if we settle below this value area high, that's going to look like the bears are more in control. The only caveat to that is this point of control here, where the most time and volume has been spent, is really close to that. So it could start dissipating that value of that value area high as a resistance level going forward. On to the mini S&Ps. Again, this 200-day moving average is really acting as a crevasse rather than a line in the sand. We've tested it several times in the last week or so, and it has held as a resistance. Today we opened up just on that line and have since been selling off. And I've talked about this. This is very bearish or not super bearish, but it is a bearish indicator that the 9-day moving average is below the 50-day moving average. It becomes more bearish as the 50-day moving average moves below the 200-day moving average going forward. This is the daily breakdown of the E-mini S&Ps, as you can see, pretty much from go this morning on the open. We made an attempt to rally, but has since really come off quite a bit. We made the overall highs overnight, pretty much over the German business climates index. Came out a little bit higher than expected and gave that a little bit of lift to the upside, but for all intents and purposes, the overall market has been acting very bearish. Then on to a few things that I've done. This was on the earnings trades, and I tweeted these out, so if you don't follow me, you can follow me at Wolfman's blog, because I throw these things out there whenever I'm doing them. I'm actually going to be looking at Boeing, Southwest Airlines, ticker symbol LUV, and Coca-Cola later on today. But these are the ones that I tweeted out late in the day yesterday. And in Visa, I went in and did strangles on all of these. And for the most part, I followed my rules with going to the 1 standard deviation strangle. That's what I tweeted out. So if you're not familiar with that, I've talked about this a lot in my daily market commentaries. This 1 standard deviation strangle is the ones with closest to 16 delta. And in Visa, I did the Octobers, the weeklies that expire on Friday, and did the 79.5, 86.5 strangle. And I originally did that strategy for 60 cents and bought it back this morning for 8 cents on the open. Then I went into Caterpillar, and in Caterpillar I did the same thing with a strangle. Covered this earlier on in this morning. It looks like it's really started selling off, but not really testing my put, so it's still probably pretty good. And I did the October weeklies again, sold the 81.5 puts with the 90 calls to create that strangle, and I originally sold that for 76 cents, bought it back this morning for 14 cents. So 2 nice wins on that one, on those two. But Procter & Gamble really kind of tried to stick it to me earlier this morning. Blasted higher, well outside of the market maker move. I still have this trade on for the most part and working to get out of it. And I did the October 82.5, 86.5 strangle. So you can see right now it is about $1 in my face, or my calls are about $1 in the money, I should say. And I collected 53 cents for that. Last I checked, it was trading for around $1.30, and I'm trying to get out of it for about 80 cents right now. So looking to try and get out of that. If I can get just a bit more of a pullback in that, then I'm going to look to cover that. So all in all, with all of my trades, I am at this point profitable on the 3 of them, the one being the one that's tested me, but I'm looking to try and work myself out of that one right now. So I was hoping maybe I could get filled during this webinar, but it's not looking like that's going to happen. Anyway, Friday's webinar is going to be on the straddle. So the straddle is where we're selling at the monies, and I'm going to talk about how to build that strategy to increase your probabilities of profit, and you should really check that one out. It's a really good one, especially for these sideways markets. If we get some high volatility, that's a really good one. You can collect a lot of premium for that strategy, in especially a sideways market. So go to protraderstrategies.com, sign up for that. That's all I got for you guys today. If you can't take that, take it easy.